And good evening, everyone. It's Thursday evening, 9:28 Eastern Time on August 4th, already up to the 4th of August. Stock market has declined quite a bit since we last visited with one another via these video presentations. Not a complete surprise. You'll recall back in May I was harping about the 1200 level in one of the newsletters that I sent out as being a long-term trend area that could be violated or tested or violated if the market found itself running into troubles, and that seemed to be invalidated by the rally that took place not too long after I had discussed that. But we know what happened to the rally as it has fallen completely apart, and the stock market has crumbled with that big over 500-point Dow decline today, so we're at 11,383 in rapid fashion. And if we go down to the S&P 500, which probably won't track on this particular screen so well, but it's right in the middle of my screen here, 1200.07, so that's what happened. We did finally make it down to what I was looking for at the 1200 level in the S&P 500, and the big question, of course, is what is next. And just as a side note, crude oil, I had mentioned 85 as a potential handle, but kind of gave up on it. But here we are, 85.82 for the price of crude, and that is on the economic slowdown situation. I'm not surprised that the stock market has come undone here a bit in recent days. I am surprised by the rapidness of the turnaround and the sudden realization after all that's gone on with the debt ceiling negotiations in Washington that the U.S. economy is returning back to a definite recessionary type of phase with barely no economic growth during the first quarter, and this contrived second quarter number showing some economic growth, but you know that is going to be downgraded as we get the revisions to second quarter GDP, and as I have mentioned and warned of, third quarter GDP, and I probably won't say this anymore, third quarter GDP likely to be a negative experience, if you know what I'm talking about. Here's a bigger S&P 500 chart, and I want to talk about trend lines. The first trend line you'll see here dates back to the year 2005, and the trend line remained intact for quite some time until the financial crisis hit in 2008. And then so much for long-term trend line. It was completely obliterated. The market struggled back and forth for a little while. Then it was a complete dump all the way down to the lows of 2009 at 666.79 back in the early part of 2009, in the spring of '09. And then the market proceeded to bounce back on the realization that the Fed was going to step in and do all sorts of special things, and it did its quantitative easing. QE1 ran out of steam in 2010. The market went sideways, as you can see, and the trend line there shows that the market had bottomed out in August of 2010 and then was back to the races again during QE2. And now the market is struggling sideways again. And this time it has violated this long-term average. My expectation had been, and this has changed along the way in terms of the trend line here, but just a closer inspection was that we would see the 1200 area, and there we are at 1200. Now, whether or not this turns into another episode of 2008 into 2009 remains to be seen. The one thing that we can glean by looking at the 2008 chart is that it was violated fairly well. The S&P 500 found itself at 1,388 for a little while, and then it got all the way down to about the 1,270 level, so that was a pretty large size decline there of roughly over 10% actually, and then it bounced back up to the 1440 level, which seems like a nosebleed level from today's perspective. And then the bottom, of course, fell out of the market in 2008, and we went all the way down to 1200 from 1440, and then the market proceeded to go, of course, completely foobar, and we got all the way down to 666. I'm not saying that necessarily is going to happen again. I do expect that perhaps QE3 might help the market, but it's sort of a hard to predict situation in terms of what the efficacy of QE3 is going to be, and just simply the realization that yes, these quantitative easings have worked. It worked when the market bottomed out at 666, and the market got eventually back to above the 1200 level in early 2010. But then as quantitative easing weared off, well, the market just didn't know what to do with itself, and suddenly the S&P 500 is a couple of hundred points lower within a couple of months. And the same thing has occurred where QE3 was introduced, as you can see, in the fall of 2010, and the market goes from this 1,039 level all the way up to a peak of 1,370. QE runs out. As you can see on the left of this chart, it's all sideways action, and finally a downward capitulation. And the downward capitulation relative to, a lot of people are making comparisons or wondering if this is 2008 all over again. And the downward capitulation here has really not even come close to what happened in 2008 and 2009. So you can glean from this that there is the potential of, yes, we will likely see some sort of a dead cat bounce, but until the QE actually comes back, I think we're talking in terms of some new levels that have yet to be plumbed in the S&P 500. 1150 certainly would not be an unreasonable projection at this point, or even looking down closer at the 1100 level. It certainly would give the Fed some good justification for telling the public that we need quantitative easing, and there will certainly be plenty of begging and pleading. Where's the money going? Well, let's take a look at the 10-year Treasury yield down around 2.39%, and here is the T-bond price ever rallying. It's been an incredible run there for the 10-year Treasury. Junk bonds have been a terrible place to be. J&K has come down quite a bit. In fact, that reminds me, let's punch in MUB here very quickly, or MUB for the municipal bonds, and let's see how that's done. Will it come up for me? There we go. MUB has remained pretty remarkably stable, and actually has forged out some new highs. So there's another message in there in terms of what's going on in this market with respect to areas where money has been flowing. Now, gold, it got up to, around the $1,280 an ounce level, and has since pulled back. Any number of different factors might account for gold, and that is Randgold Resources. I forgot to put a little dollar sign in front of that, so let's put a dollar sign in front of that and get the continuous spot gold price. Yes, it did rally well past 1650. It's in the 1640 area this evening. It's just a little blip on this chart, which goes back to February. It's pretty amazing, gold. Nowhere near any type of major moving average. This type of consolidation is to be expected. So anyway, that's it in a nutshell, folks, is that perhaps we get a little dead cat bounce soon, especially on these 90% plus days, which is what we saw with the Dow Industrials certainly today, and these market indicators are oversold, but the technical damage has been done for the time being, and until there's some sort of announcement from the powers that be about rescuing this market, it's going to be in limbo for a little while, just given what's going on in the world and even what's going on here in the U.S. in terms of virtually no economic growth. So tighten your seat belts and continue to look for a bumpy ride. It actually probably would be counterproductive if they came out of the woodwork very quickly, the powers that be, and announced some sort of scheme or mechanism to try to bring confidence back into the stock market. Probably would only scare people more at this point. Jackson Hole, Wyoming Fed conference coming up in a couple of weeks. Maybe that's how they'll wean the bears off of whatever kind of power juice that they're drinking at the present time. Have a good evening, and I'll be back another day, hopefully.